Hello, it's Richard Pears from FinextraTV, and delighted this afternoon to be joined by David from Vedantics. Very good to see you. How are you today?
Very well, thanks. Great to be here, Richard.
It's really good to have you here. David, of course, is the CEO of Vedantics and produced a really interesting market overview report of ESG and ESG data providers, which we're going to talk about today. David, tell us a bit more, though, about you, how you got into this particular space and what the report is covering.
Sure thing. So Vedantics is an independent research and advisory firm, and we operate out of London and New York. And I actually founded the firm over 12 years ago to focus on sustainability issues at the time, and covered climate change, sustainability, carbon trading exchanges. And then the financial crisis hit, and a lot of those bold initiatives didn't really expand in the way that people were expecting to do through the 2010s. We nevertheless continue covering many of those topics in our technology research. And of course, from 2019 onwards, we've seen a huge change in the focus and level of investment into sustainability and now ESG as well.
Fantastic. So tell us, how did you go about the survey? What was the scope of it? And give us some of the top line findings.
Well, the question that we really pose to ourselves is, what has been the impact of the hugely increased interest of the financial markets in the last 2 years on ESG, and how has that impacted the thinking of the corporate world? So I think everyone understands that in 2019, that's really when we saw ESG become a major theme in terms of the thinking about the development of new financial products, new strategies, and even new markets. And then in 2020, I suppose the jury was out a little bit, how is the pandemic going to affect this? And surprisingly, it actually accelerated the thinking around ESG in the financial space. So what we're now saying is, well, how are the corporate players how are the issuers going to be responding in 2021 and beyond?
Right, I see. Now, so the report that you've put together, I've had a good chance to have a look at it, and it's really interesting. Some really good, visual diagrams in there as well. It's not just, one of the wordiest things, and there are a lot of those around at the moment. You talk about a number of things, the barrage of requests to corporates for corporate disclosure. You talk about ESG data providers and the acquisition trail that's been done of the sort of boutique players by the big market data providers. What are the key themes that are coming out for you over and above the ones I've highlighted?
Well, I think what we've done is we've almost role played it from the point of view of a CEO and a CFO at a listed company, and said, well, how have things changed, and to what extent do they need to ramp up the way that they engage with ESG topics? So what are some of these changes? Well, one of them is that 3 years ago, many of the requests that they would get around ESG were coming from boutique companies, located in Switzerland or, dotted around the world. But fundamentally, they may have said, well, we don't really have time to deal with this. And through all of the M&A that's happened over the last 3 years, it's now S&P, it's Moody's, it's Bloomberg, it's Refinitiv. And so they really do need to respond to that. So I think that's been one of the biggest changes that has impacted them. And then at the same time, we're also seeing regulatory developments, both in the EU and now with the new administration in the US, where there's going to be more pressure, especially around climate change disclosures, but also the requirement to better understand the need to avoid greenwashing in terms of any ESG or sustainability disclosures. And those two factors, I think, are the big driving forces for the issuers to have to engage in a more active way on this.
And you make the point, obviously, that about the sort of data asymmetry, and for some people, a lack of correlation is between the big data providers is a reason to do nothing, and reputation risk, whatever that may come of choosing the wrong data. But on other hands, it's a benefit. It's a reason to sort of get into more fundamentals and look at their existing systems of record. Tell us, unpack that a bit for us, how you see two sides of that coin.
Yeah, I mean, it goes back to the start point that we had, that the financial markets have pulled far ahead of most issuers in terms of the quality and range of information and the analytics that they're running on ESG data. So again, role playing from a CEO's point of view, do they want to go into an earnings call? Do they want to have a meeting with investors behind closed doors and find out that those investors, those equity analysts actually have more data about their own ESG risks and opportunities than they have? That's why we talk about it as information asymmetry. And of course, no CEO wants to be in that position, but increasingly they are. And so this is then triggering a focus on, well, how can they increase their own level of insight into the risks and opportunities that they face? And what we found is that they can rely on existing systems of record, as you said, Richard, that they already have in place. So, environment, health and safety software, this will actually provide them with a lot of detail around performance in those areas. They may have governance, risk and compliance software as well. So that will help better understand some of the issues there. And also there are systems of record for things like employee engagement or supply chain transparency. That helps with the S in social. So it's not that they are in a terribly weak position and with no data. That they just need to, I think, fire up a project to get that pulled together into an enterprise view, so they can then go into a meeting with investors on the front foot and say, here is our full understanding of all the risks and opportunities we have in relation to ESG. And an output of that, we would say, is that they can then improve their ESG scores and ratings. But that shouldn't be the fundamental reason why they invest in these kind of ESG information architectures.
Yeah. So, and then we spoke briefly beforehand. How do you counter the sort of argument where people say, well, I'm on the financial market side, and I might be getting access, directly in the way that you've just described from the corporate because I'm, a primary investor with them. But if I'm in the sort of portfolio assembly market, I've got to rely on a universality of data and the ability to benchmark. How do we start to get that information out of those systems of records and into the hands of the portfolio players? And this is where today the statement is it's all got to be standardized and a universal truth, which is going to take forever. Or is there another way that you've started to identify?
Look, I think that's right. If you're a CFO, if you're Director of Investor Relations, then you need to play the ESG ratings and ESG scores and metrics game as well as you possibly can. And that's why we're starting to see some of the bigger finance teams appointing a senior manager who's just responsible for ESG. So one of the things that's happened really just in the last couple of months is that the big ESG ratings providers are now providing free access to corporates to at least get some level of information about what their score is. But then it's a case of having a dialogue with them to understand what methodologies they're applying and what data you as an issuer should be offering to them in the public domain, as you say, in a standardized way that may increasingly be shaped by the IFRS or other financial markets regulators, so that you are playing that game as well as you possibly can. Because certainly at the moment, what we're seeing is some strange disconnect, if you like, between high scores, for firms where you're surprised by their positive ESG rating, and others where there's a lack of correlation across the different scores from different rating providers.
And then in your report, you start to draw out a couple of things which are of interest. I think you've got a lot of the data providers, both as you've described it, the big MSCIs, the acquisitions, and the boutiques, and the kind of values, etc., going on there, and the direction. You've also got of travel, and you also talk about the different strategies being applied by corporates from sort of if you will, the ostrich. You don't use this language, but head in the sand approach to fully out there and embracing it. Tell us a bit more about what signals that's giving you of what's happening in the market.
Well, yeah, I mean, I think what's happened in the past is this whole passive approach to sustainability management, where corporations have felt, well, there hasn't really been very much pressure on them to change what they're doing. And what we've seen in the last couple of years is ultimately that's becoming an increasingly risky approach. Which is being exposed by the big investments by the likes of Moody's and MSCI and S&P Global in rather sophisticated ESG analytics engines. But then around the edges of that, we're also seeing more risk to issuers who don't have a ESG kind of data strategy themselves, from things like the launch of satellites, which are tracking fugitive greenhouse gas emissions, GHG sat, being a great example of that, or else other firms like RepRisk, who are monitoring thousands of data sources from NGOs and governments, which could also flag up risks to issuers. So ultimately the calculus of, well, we only need to invest $500,000 a year in our sustainability strategy, and that's okay. That is no longer fit for purpose because the risks of having that kind of passive approach are not sensible. But at the same time, we're not advocating, everyone has to become like Impossible Foods and replace their entire product line with kind of vegan alternatives, right? There's a long transition that needs to be put in place.
Gotcha. Well, look, there's so much in the report to unpack. Tell us, how people could find out a little bit more about it. Website details or whatever it might be, and then please do tell us, what else next we can expect.
Sure. So there's information on Verdantix.com that you can find out about, and actually we're running a virtual event in April, which is going to be focused on all of the issues around ESG, data management, information and ratings. So that will be a great event to participate in. What we're actually going to be doing over the next 3 months is producing detailed studies on ESG and sustainability software that is designed for the issuers. So what is out there? What functionality does it have? Which industries is it a good fit for? And then we're actually going to be following that up with a very detailed overview of all of the different ESG fintech platforms, if you like. So what is available if you're part of the financial markets, both in terms of data sources, but also information and analytics and ratings providers. And actually it's a much, much broader universe than maybe people think about at the moment.
Yeah, definitely, and proliferating for sure. David, for now, thank you so much for your time and for sharing all that information, and look forward to the next update.
Thanks very much, Richard. Great to be part of FinextraTV.
You're very welcome.